Welcome to the Hurst Trading Room. My name is David Hickson and today is the 30th of May 2016. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. Today's webinar completes a sort of a small cycle of webinars that we've been having, in which I have been discussing moving from a Hurst cycles analysis to making trading decisions on the basis of your Hurst cycles analysis. And in today's webinar, I would like to discuss something that isn't often mentioned, something that I call an analysis risk, which is the risk that you're taking on the basis of your analysis. And it's something that's always fascinated me. It's very easy sometimes to be seduced by all those diamonds and circles and whiskers at the bottom of your chart, and you get very involved in the analysis process. Then, of course, you move on to making trading decisions. And one of the things that many people don't really consider is what is the risk that they're taking on the basis of their analysis. So that's what we're going to be discussing today. Welcome everybody. I see lots of people coming in and saying hello to all of you, and happy Memorial Day if you're in the United States. I think that many of our US colleagues are taking it easy today. So happy Memorial Day if you are there. So let's just do a quick recap on what we've been speaking about over the past few webinars. This is an analysis of the S&P 500, and we've been discussing the trading opportunities that have been available to us. And in the past webinars, you will know that I have been discussing in particular the 20-week cycle trough, which I've been expecting to form. And I'm trying a new pen, so I'm hoping this is going to work, because I've had some problems with the pen on this computer. But here is the nest of lows for this 20-week cycle. There we go, which of course forms a triangle standing on its head. A nest of lows is made up of the circle and whiskers of the expected time that a trough is expected to form, and the longest cycle in that particular trough is, in my opinion, the 20-week cycle trough. And so we've been discussing entering a trade as price bounces out of that 20-week cycle trough. And as I've mentioned in our previous webinars, I have been expecting the 20-week cycle trough to probably occur early. We're going to speak a little bit more about that in a moment, but I've been standing by. And of course, one of the important things to bear in mind is that you should start standing by really when this line starts forming on your chart, because that line indicates the range of time that the 20-week cycle trough could form in the market. And so we were standing by. In our previous webinar, I spoke about the 20-week FLD. You know that I find the FLD particularly useful, and in particular the sequence of interactions between price and the FLD. And we spoke last week about how price broke up above the 20-week FLD over here. Where was that? At the beginning of March, and that is what we call an A category interaction, after which price is expected to come back down to the 20-week FLD and is expected to find support at the level of the 20-week FLD. And it is expected to find that support at the level of the 20-week FLD at about the time that the 20-week cycle trough is forming in the market. So that is what we call a B category interaction. And this is the FLD trading strategy approach, which is a simple approach that studies the interaction between price and the FLD. It's an extension on Hurst's original discussion of what FLDs are and how they work, and it is something that I developed as a result of years of watching prices interact with FLDs in a fairly obsessive manner. I'm very interested in seeing how price interacts with these FLDs, and I have been for years. And so I developed the FLD trading strategy. And the FLD trading strategy tells us to expect a sequence, a fairly reliable sequence of interactions between price and the FLD. And in our previous webinar, I spoke about how I expected the 20-week cycle trough to form at about the level of the 20-week FLD. And at that point, we would have a good trading opportunity to get into a long trade for the bounce out of the 20-week cycle. And as you can see, that's pretty much exactly what happened. And so now we're in a trade. I'd like to tie up some of the sort of other loose ends surrounding making trading decisions. And that's why I'd like to speak specifically today about analysis risk and what that means. But just to finish our recap, when we were discussing the trading opportunities that were presented to us, I spent some time discussing the concept of a dominant cycle. And I'm going to come back to it because it's a very, very important concept. A dominant cycle, you should know, is a cycle which is visually evident in the price action. In other words, it's a cycle that you can easily see. And in fact, let me zoom back on this chart and show you how, when we're looking back with the benefit of hindsight, we can identify some dominant cycles. Let me turn that FLD off. A dominant cycle is very simply a cycle that you can see on the chart. And it is a cycle that moves price up and then it moves it down again. And that move up and that move down should be fairly proportional. They don't have to be equal. They very seldom are completely equal, of course, but they should be fairly proportional. And so there you can see a good strong move up, followed by a good strong move down, a slightly larger move down. And that was over a period of 40 weeks. According to this analysis, I had some emails 2 weeks ago following our previous webinar, asking me why I called this a 40-week cycle when in fact it was a period of only 24 weeks. The reason why I call that a 40-week cycle is because in the analysis, it's been analyzed as being what we call the nominal 40-week cycle. The average length of the 40-week cycle is about 40 weeks. Sometimes it runs very short, 24 weeks. Sometimes it runs very long, 50, 55 weeks. But I call that the 40-week because in my analysis, that is the cycle that I'm seeing there on the chart. So that is what is meant by a dominant cycle. It is very simply a cycle that you can see quite clearly. It moves price up and it moves price down fairly sort of proportionally. So what we have seen since the February trough is a strong move up, and we then saw a small move down. Now that's not what I call a proportional move. Okay, it's a very, very small sort of a correction. And so clearly the cycle that elapsed over that time period, and I'm expecting that to be a 20-week cycle, and so the 20-week cycle is not dominant. It must be a longer cycle that is dominant, because there's a particular feature that's really important to understand about dominant cycles, and that is that when you have a dominant cycle moving price up and then down again, then the trough of the cycle one shorter than the dominant cycle. So I've already mentioned this is the 40-week cycle. So the trough of the cycle 1 degree shorter, which in this case is the 20-week cycle, that trough will be what I call a subtle trough. It is often a straddled trough. It's basically a trough that just doesn't look big enough for the magnitude of cycle that is causing it. And it's something that causes a lot of confusion when people first approach Hurst cycles, is that we say, okay, there is a 20-week cycle trough, but price only bounced out of that trough for about a week or 2 weeks after that. And it only fell into that trough for about 2 weeks prior to the trough. So it doesn't look like it's a really powerful 20-week cycle trough. You would expect price to bounce for 10 weeks following a 20-week cycle trough. And that is, of course, one of the big misperceptions or misunderstandings of how cycles work together in the market. So when you have a dominant cycle of 40 weeks, then the cycle 1 degree shorter, the 20-week cycle, will experience a subtle trough. It's a very important point. And so when we were discussing the identification of our trading opportunities, and I mentioned that the dominant cycle in the market was possibly 40 weeks, then that would have meant that we would have expected a subtle 20-week cycle trough. And so when that trough formed 10 days ago, it was a very likely candidate for that 20-week cycle trough, because we were expecting a subtle trough to form if the 40-week cycle was dominant. A few other things about dominant cycles before we move on. Many people speak as if though there is only one cycle that is dominant in the market. I have a slightly different opinion, and I know not everybody agrees with me, but I believe that there can be multiple cycles that are dominant in a market at any one time. For instance, if we have a look at this time period, you can see a clear upwards and downwards move. That is a dominant cycle. That's the definition of a dominant cycle. At least that's my definition of a dominant cycle. Well, not mine, sorry, that's Hurst's definition of a dominant cycle, but that's how I understand a dominant cycle, to have a strong move up followed by a strong move down. And that is, of course, an 80-day cycle. And over here, you've got another cycle with a nice clear move up and a clear move down, and that's a 40-day cycle. And over here, we've got a fairly balanced cycle, 40 days, and another 40 days. So we're seeing fairly dominant 40-day cycles in there. We're seeing a dominant 80-day cycle. And over the entire time period, you could say that the 40-week cycle itself was dominant. So I believe you can have multiple dominant cycles at any one time in the market. So that's just a point I wanted to clarify, because I had some questions about that. So we entered into our 20-week cycle trough trade, or at least our trading opportunity was for entering into a long trade as price bounced out of the 20-week cycle trough. And as I mentioned in our previous webinar, what we would have been doing was we would have been looking at identifying good entries into this trade. And we spoke last week about using Hurst cycle tools such as VTLs. Here's the 20-day VTL, which would have provided us with a good entry point into that 20-week cycle, the bounce out of the 20-week cycle trough. We also spoke about FLDs, and let me turn off the VTL. Of course, there's the 20-week FLD, which provided support for price. Not perfect support, of course. Price did drop down below the FLD for a good day and a half. But as I mentioned, the 20-week FLD is probably better viewed on a 20-week resolution chart, because you get a lot of sort of wiggles and things. And there it is on the 20-week cycle, on the weekly chart, and you can see price came down and formed a sort of rough support at the level of that FLD. The other way of finding an entry would have been to use one of the FLDs, such as the 80-day FLD. If you were being cautious, you could have waited for the FLD, the 80-day FLD. In fact, the 80-day FLD gave a fairly good entry. You could have used maybe the 40-day FLD, although as we discussed in the previous webinar, I believe I mentioned how because price had been tracking along that FLD, it provided a fairly difficult FLD to make an entry on the basis of. Prices tend to very often track long FLDs, and you can see a really good example of that over here. By tracking along, I mean that the high price of the day is sort of above the FLD, and the low price of the bar is below the FLD, and so the FLD price straddles the FLD. And as you can see, it straddled the 40-day FLD for a period of almost 2 weeks over here. So the 40-day FLD wouldn't have provided a good FLD for entry. It simply wasn't available to us. That sometimes happens. And here is the 20-day FLD. And the 20-day FLD possibly could have given us a good entry level. Okay, so we've potentially entered into a trade, we've identified a trading opportunity, and we've entered into the trade. First of all, something I would like to speak about just for a moment are these diamonds at the foot of the chart and the circles and whiskers. Now, the circles and whiskers are, of course, the sort of, the circle is the exact time that a particular trough is expected, assuming that the cycle keeps beating with exactly the same wavelength, which we know it doesn't often do because of the principle of variation. And so the circle gives us an indication of when we can expect the trough. The whisker, or the line on each side of the circle, tells us the range of time that the next trough could be expected. And once the software, or if you're doing this manually, once you as the analyst is confident of placing a particular trough in a position, then you draw these diamonds at the foot of the chart. Okay, so these diamonds represent the sort of the confirmed placing, if you like, of those troughs. Now, some people, when they start working with Hurst cycles, fall in love with the diamonds. Diamonds are a trader's best friend, and they really love those diamonds because it gives them a sense of confidence. You know, those diamonds are nice and neat, and the diamonds give you a sense that, there's the trough, and I've identified it, and it's wonderful. The circles and whiskers sometimes can look a little bit messy, as these do here. You know, they're sort of sprawled all over your chart. They're a little bit messy, and they contain too much uncertainty, really. And so many people, when they start working with Hurst cycles, really love the diamonds, but they're a bit worried about the circles and whiskers. And I think that's a mistake. If you wait for a diamond to form on the chart, if you're working with Sentient Trader, or even as an analyst, if you're waiting until you can draw that diamond on your chart, then you've missed your trading opportunity. It's a very, very important point. It's not a flaw in the software or a mistake in your approach to the analysis. You shouldn't be drawing diamonds until you're confident that that cycle did form a trough at that particular point. The important thing on your chart when you're making trading decisions are these circles and whiskers. As messy as they might be, they are really where you should be putting your focus, because they are telling you what trough you're expecting to form in the market. And that's telling you what you're expecting next. And so the first thing you do when you make a trading decision, and even after you've entered your trade, a very important thing to do, I believe, is to not just sit back and put your feet up and say, okay, great, I've entered a trade and that must be the 20-week cycle trough. The important thing to do is to ask yourself, what is my cycle expectation? What am I expecting here? And of course, it's really important to remind yourself all the time, why did you make that trading decision? And we made this trading decision, or I made it in our previous webinars, because I was expecting the 20-week cycle to form a trough. And so I would have entered into a long trade as price bounced out of that cycle trough. That was my cycle expectation. And as a matter of interest, and I've mentioned several times that I have expected the 20-week cycle trough to occur early. And it's a really important thing. You don't necessarily just look at your charts. These charts, using Hurst's cycle notation, are using the recent measured average wavelength of the 20-week cycle, the 80-day, 40-day, and so forth. And that's how the software is drawing these circle and whiskers. Okay, so that's on the basis of the recent wavelength. You have to also ask yourself, what's my expectation? Am I expecting that wavelength to get longer or to get shorter? Some people might say, well, you can't possibly say. The principle of variation results in constant variation, but in fact there are some rules of thumb that you can use to determine whether a trough is expected to occur early or late. And the simplest of those methods is to look at the underlying trend for that cycle. The underlying trend is the combined effect of all of the longer cycles. So we're considering a trough of a 20-week cycle. What's the underlying trend of the 20-week cycle? Well, we look at the longer cycles. The 40-week cycle is still going up. You might argue that it's in the process of topping. So if it's in the process of topping, which it should be, the 40-week cycle, then perhaps we don't count that as a bullish impetus or a bearish impetus. Because it's in the process of topping, we give it a 0 score, a neutral score. The 18-month cycle is going up according to this analysis, so we give it a score of +1. The 54-month cycle, according to this analysis, is going up. Now, you might be working with a slightly different analysis that has this trough in February as only of 18-month strength, and this is where those different analyses will tell you to expect slightly different things. You might also be working with the analysis that has this trough in February as being a trough of the 9-year cycle. Or I know many people nowadays are working with a 7-year cycle. I received interesting email this week about somebody comparing Ray Thomes' work with the 7-year cycle to the possibility that a 7-year cycle is active in the market. So, possibly there's another diamond over there for the 7-year cycle, and that's also going up. So maybe we should even add another one. Anyway, the underlying trend, if you add up all of those things, all of those cycles, is +3. Or it might be +2 if you have a different analysis. But nevertheless, it is positive. And when you have a positive or bullish underlying trend, you expect cycle troughs to occur early. That's the rule of thumb. And so I was expecting this 20-week cycle trough to occur early, and indeed it seems to have occurred. But now that we're in our hypothetical trade, we now need to, instead of just sitting back and relaxing and saying, yes, wonderful, I've traded the bounce out of the 20-week cycle trough, let me just relax and enjoy my profits. We now need to consider a very important aspect of any trade made on the basis of Hurst cycles analysis, which is analysis risk. And there are two aspects to analysis risk, in my opinion. The first risk that you're taking is that your analysis is wrong in one way or another. And that is possibly the most serious analysis risk. So, in other words, if you're entirely incorrect about your analysis, then you might be taking a risk with your trade. The other analysis risk is the risk that you're taking if your analysis is correct. And I'm going to come back to that because that's a little more complex. And most people think if their analysis is correct, they're taking no analysis risk. But I actually think that there is some analysis risk, and we're going to come back to that and speak about that in a moment. First of all, what is the analysis risk that we're bearing here in this trade if our analysis is incorrect? Well, of course, the first thing you have to do is you have to ask yourself, if my analysis is incorrect, and this nice little trough that formed over here that I potentially entered into a long trade as price bounced out of, I see a comment there from William, somewhat analogous to filter lag. I think perhaps I've moved on and forgotten what I was saying at that point. Sorry, William. Let me just complete this train of thought. So I entered this trade on the basis that price was bouncing out of a 20-week cycle trough. Now, could I have been wrong? Might that not be a 20-week cycle trough? Yes, indeed, and it's been one of the things we've been discussing over the past several weeks. That might not be a 20-week cycle trough. I believe in looking ahead and making trading decisions on the basis of what is coming, rather than waiting until we have 100% evidence that it has occurred. And you make trading decisions on the basis of the probabilities rather than the certainty. But it is also possible that this trough here was a trough of the 40-day cycle. Can you see? Here's the nest of lows for the 40-day cycle. That nest of lows for the 40-day cycle is leaning over to the left, which means that that 40-day cycle trough came in later than was expected, which already makes me think it's less likely that it was a trough of the 40-day cycle, but it is possible, and we should consider it. So there's another quick little point that I like to make about these circles. When I see a circle, sort of in the past, I like to go up and look and see if there is a trough in price at that time. Can you see that trough there? That doesn't mean that is definitely the trough of the 40-day cycle, not at all. But when I see a trough forming where there is a circle on my chart, I think the chances are fairly high that that trough has formed in the market. So I don't think there's a great chance that this is a trough of the 40-day cycle, but we need to bear this in mind. We need to bear this possibility in mind, because if that is a trough of the 40-day cycle, then we need to keep on our toes, benefit from the profit that we can make, but we need to be standing by to get out. Why? Because if that is only a trough of the 40-day cycle, then what are we expecting to happen? Well, if that is a trough of only the 40-day cycle, then we are expecting another 40-day cycle to bring price into the 20-week cycle trough, which would happen in another 40 days. So this analysis risk warns us to be a little bit careful and cautious and monitor this trade carefully. It doesn't mean we're going to lose money, but it means we probably need to stay on our toes and try to work out as quickly as we can whether this trough that has formed, that we've traded as price bounced out of, is that a trough of the 20-week cycle, or is it a trough of the 40-day cycle? That's going to be your pressing question as you approach the markets every day. And you're going to be asking yourself, what was that trough? I'm in a profitable long trade, but if it was only a trough of the 40-day cycle, I probably need to get out of this trade pretty quickly. One of the great things about working with Hurst cycles is you can often be wrong in your analysis, but still make profitable trading decisions. And it's because of this whole process. So let's consider this seriously. Could that be a trough of the 40-day cycle? Yes, indeed, it could be a trough of the 40-day cycle. It is possible. How would we know? Well, what we need to do is we need to look at the evidence. And of course, I always pull up my FLDs. So we're going to take a look at some FLDs first of all. But let's ask ourselves the question, if this is a trough of the 40-day cycle, then what kind of cycle expectation do we now have for our trade? And what I like to do is I look at the previous 40-day cycle shapes in the market. So there is the 40-day cycle, the first 40-day cycle following the February trough. Very nice, very bullish cycle shape. Here is the next 40-day cycle, also a bullish cycle shape, not quite as bullish, which is what you would expect, because following this trough in February, you would expect very bullish, less bullish, then probably neutral, and then bearish as price comes down into the 20-week trough. So if this was a trough of only the 40-day cycle, then we have seen a fairly neutral shaped cycle, as we would have expected. And the next cycle, the cycle that we are then trading, would be expected to be a bearish 40-day cycle. So that's very important. Now we know that if the trough that formed, when was it, in sort of middle of May, I'll remind myself of the exact date in a moment, but the 40-day cycle that follows that trough would be expected to be bearish if it is a trough of only 40 days. So now we have some reasoning to sort of tag our understanding of what is happening onto. So what can we do? Well, what I do is I take a look at the FLDs, of course. Bear in mind that if price is bouncing out of a 20-week cycle trough, then we would expect the current 40-day cycle to be bullish. Okay, because it's the first 40-day cycle in a 20-week cycle, it must be bullish. So it will be heading upwards. And if, however, it is a trough of only the 40-day cycle, then, as I've just pointed out, we would expect it to be a bearish 40-day cycle. So what do we do? Well, you will know that the FLD trading strategy, because I speak about it so often, tells us how we expect price to interact with the FLD. So if price is bouncing out of a 40-day cycle trough, which FLD do we look at? Well, I look at the FLD which is 2 cycles shorter. So 2 cycles shorter than the 40-day cycle is the 10-day cycle. So let's display our 10-day cycle FLD. There is our 10-day cycle FLD. Now, what do we expect if this 40-day cycle is going to turn out to be a disastrously bearish cycle, which is looking less and less likely, I must say, as price bounces up. But early last week, you wouldn't have seen this big rise up to almost match the previous high. And so you would be looking at this with some trepidation and watching that 10-day FLD very carefully. Now, if this is a bearish 40-day cycle, then we would expect price to cross up above the 10-day FLD in an A category interaction. Then price comes back down to the 10-day FLD in a B category interaction. That is a decisive moment when price comes back down to the 10-day FLD. If the cycle that we are trading is very bullish, in other words, we are bouncing out of a 20-week cycle trough, then we would expect to see price not even quite reaching the FLD, but definitely finding support at the FLD before continuing upwards. On the other hand, if this is a bearish 40-day cycle that we are currently in, then we would expect price to come down to the 10-day FLD, perhaps find some temporary support, but very probably break down below that 10-day FLD. Okay, so the way in which I monitor my trades and answer the big question of, is that trough there on the 19th of May, is that trough a 20-week cycle trough, or is it perhaps the less profitable situation of it being a 40-day cycle trough? I monitor that process by looking at these FLDs. Now, here we're looking at a daily chart, and we're considering a 10-day FLD on a daily chart. That can be sort of slightly frustrating because the 10-day FLD, there isn't a lot of detail. So why don't we take a look at a live chart? I have a live chart of the same instrument, the S&P 500 here. This is in fact the cash index. This is not the ES futures as a matter of interest. Yes, this is the cash index. Here you can see the analysis on the daily chart. And you can see a really interesting thing has happened on this chart. Can you see it? The recent trough has been labeled, according to this analysis, as a 40-day cycle trough. There it is. Now, some people worry about that terribly. We're trading the bounce out of a 20-week cycle trough, and yet the software has put a 40-day cycle trough in there. I don't let it bother me too much. Analysis is it's an art form, in my opinion. It's a complex process, and sometimes those troughs are placed in there, and you mustn't take it as gospel, as they say. When you see a diamond there, it doesn't mean that's definitely the 40-day cycle trough. You have to look at the bigger situation, and the bigger situation here is that we've got the whiskers for the 20-week and the 80-day overshadowing, sitting like an umbrella over that 40-day cycle trough. When I see that happening very often, it means that 20-week cycle trough has come in, has happened. The important thing, in my opinion, is that you know what to expect. That's more important than actually confirming the trough once it has happened. I hope that makes sense. Perhaps there are people who will disagree with me, but in my opinion, it was more important to be able to expect the 20-week cycle trough to form in the markets rather than sort of splitting hairs and worrying about the detail about whether where those diamonds get placed. But the important thing is here we have an intraday chart, and we can start taking a look at these FLDs at a slightly greater resolution. So here is a 4-hour chart, and I've zoomed into just the period since the trough on the 19th of May. And here is the 10-day FLD. Okay, so again, our expectation is that if this is a trough of the 20-week cycle, then we would expect price to cross up above the 10-day FLD, and then it's going to be very important seeing how it reacts to the 10-day FLD at the time that the 10-day cycle trough forms. When is that 10-day cycle trough going to form? Here's the nest of lows down at the foot of the chart. As you can see, it's quite a nice, neat little stack, neat nest of lows, indicating that the 10-day cycle trough was in fact expected to form on Sunday, yesterday. Okay, you can see this sort of gap in the chart. That was the weekend. Now, if you're surprised to see gaps in these charts, it's because Hurst cycles work on the basis that the cycles influence price movements over time, whether we're trading or not. Whether the US is taking a Memorial Day holiday or not, these cycles keep beating. Of course, trading is affected by holidays. It's undeniable. Trading slows down as the market approaches a holiday, and it takes some time to catch up again after a holiday. But the important thing is that generally, when you look back over time, you'll find that these cycles keep beating regardless of whether we're trading or not. And so that's why Sentient Trader plots these intraday charts with those gaps there. I'm going to show you a chart in a moment on MetaTrader 4 which doesn't have the gaps, and it's interesting how it gives a slightly different but very similar picture. Okay, so the 10-day cycle trough we were expecting basically yesterday, today perhaps, and that's when we would be expecting the 10-day cycle trough to form. Now we know our sequence for the FLD trading strategy gives us an A category, and then at the time that the 10-day cycle trough forms, we're expecting a B category. As I've mentioned, if the 10-day FLD, which is this pink line over here, provides support to the market, or the market forms the 10-day cycle trough well above that FLD, then that increases our confidence in the fact that the trough that the price is bouncing out of is a 20-week cycle trough. If, however, it is only a 40-day cycle trough, as indicated on this analysis, then we would expect the FLD to not provide adequate support, and we would expect price to drop down below that FLD. The B category interaction is an interaction where price is usually supported by the FLD, unless the underlying trend of the current cycle is particularly bearish, and we're expecting a bearishly shaped cycle, which, as I've mentioned, we are if that is only a trough of the 40-day cycle. Okay, so far things are looking quite good. We expected the 10-day cycle trough to form perhaps sometime over the weekend, and it was well above the FLD. Let me just clear those pen marks. Here is price. Who knows what might have happened over the weekend if we had been trading, but nevertheless price is pretty high above the general level of the FLD, which is down there. So far this is looking really very good. We can extend this process, of course, and look at some shorter and shorter charts. As you look at shorter and shorter charts, perhaps you get a little more information. You don't get a huge amount more information. But what Sentient Trader does, as it works with the shorter and shorter intraday charts, is you will notice that it does start positioning these troughs. Can you see Sentient Trader has positioned a 10-day cycle trough over there? And sure as anything, it happened on a Sunday. It happened right here in this gap. How did Sentient Trader do that? I'm not going to bore you with the details, but the important thing is that Sentient Trader believes that 10-day cycle trough should have formed by now. And the important thing in terms of our trade is that 10-day cycle trough has certainly happened above the FLD. Perhaps price is going to come down, and come closer to the FLD. We'll definitely keep watching it. The important point is that we expect at the 10-day cycle trough, we expect it to be well above the FLD. As it is well above the FLD, my confidence in the fact that we're trading a 20-week cycle as we expected is increased. Okay. We can also go all the way down to a 15-minute chart and look at a 15-minute chart. Let's not bother with that just now. So, in terms of our analysis risk, our first analysis risk is, of course, that our analysis is wrong. and that we're not trading a bounce out of a 20-week cycle trough as expected, but we're trading the bounce out of a 40-day cycle trough. We handle that risk by monitoring the market closely and watching the shorter and shorter FLDs and watching the cycle shapes as they unfold. Let's quickly have a look at another possibility that's happening here in this analysis. I see John saying, have you thought of looking at the industrial index? This index of large cap stocks would suggest a 20-week low at about 17 weeks. Okay, so a very important point. I do look at the industrial index. In fact, let's now, what I'd quite like to do is take a look at the DAX, which is the German index. I think it's important to look at different markets. I don't have a chart of the industrial index loaded up here, so we can't do that here. But it's really very, very important, in my opinion, to look at the different markets and see what the different markets are showing you and telling you is playing out in the markets. And for instance, I'm showing you here a chart of the DAX because it sort of brings me to a point that I wanted to make about the 80-day cycle. In the other analysis that we've been looking at, the positioning of the 80-day cycle is very difficult to get right because those markets were just heading upwards. But in the DAX, you can see quite clearly where that 80-day cycle occurred in the market. And that's the important point. So I think that's what John is saying there. If you look at the industrial index, you probably get a much better idea of the magnitude of the trough. So it's another very, very important thing to bear in mind, to keep your eye on other markets, other related markets, and sometimes completely unrelated markets. For instance, I track the South African Rand exchange rate, which remarkably sometimes beats with a rhythm very close to the American markets, which shows how influenced the South African economy is by what's happening in the American economy. But let's consider other possibilities that might be happening here. And one of the reasons why I keep lots of charts with the same instrument but with different analyses is because I like to keep an eye on these different analyses. And you might remember this chart, which I shared with you a few webinars ago, where I was considering the different possibilities. And I asked myself, could we have been heading down into an 80-day cycle trough? And you can see that I pinned this 40-day cycle way back here in March. And Sentient Trader is stoically keeping that 40-day cycle clean for me to consider. But look at what's happened to our circles and whiskers. They've just become a complete mess. In fact, this 80-day circle and whiskers just forms one never-ending line. That's a sure indication that this analysis is not clear and probably not very good, actually. Again, let's draw a line from the 80-day circle, see if we see a trough there. There it is there. I think the chances are pretty high that that's the 80-day cycle trough over there in the first week of April. So this is another analysis that we could consider. Yes, is it possible that the trough that we're trading the bounce out of is only an 80-day cycle trough? It is possible. How does that change our trading? What difference does it make? Well, again, and I'm not going to go through all the details, but again, we're going to watch the interaction between prices and the FLDs of the shorter cycles each day, or if you're trading intraday, every minute or every 5 minutes, every 15 minutes, you're monitoring the situation, making sure that these cycles are behaving, or prices behaving the way that it should be, according to the cycles that are moving it, or the cycles that you are expecting to move it. So let me not sort of spend too much time there, because I still have a bit of material to get through today. But I'd like to point out something interesting that's really obvious on this chart. You can see this trough here in the third week of January and this trough here in the middle of February. There were only about 2 points that separated them. And so all of the analysis that I've been looking at here is based on the fact that the 18-month cycle trough formed in February. And I'm speaking about an early 20-week cycle trough forming. And, we can measure, let me just switch back to that chart. And am I on the right chart? Yes, sorry, let me just zoom out again. There we go. Something strange happened with my pen. So if we measure from February, then that 20-week cycle trough occurred at 98 days. That's very early for a 20-week cycle. Your average length for a 20-week cycle is 136 days, and so that's 38 days early. You know, that's 35% early, pretty much, or a little bit more, 38% early. So that's very early for a 20-week cycle. But what if we considered this trough just a few weeks earlier, which was only 2 points higher? What if we considered that as the trough of the 18-month cycle? You can see then the 20-week cycle occurred at 120 days. So that's another possibility. And it's something else to bear in mind. If we double-click here, we can read the low there was 1812, and the low on this day was 1810. There we go. So, a very subtle and very slight difference between those. What else could be happening if our analysis is wrong? Well, the other thing that could be happening is the analysis that's presented on this chart. You can see why I like to keep so many charts going. Because they show different analysis possibilities, which I can then look at and consider. Now, this chart is being analyzed with a short nominal model. It's in fact the nominal model that John uses for gold. It has a 7-year cycle in it, and it's a very interesting nominal model to work with. So you can say that you can see that according to this analysis, the 7-year cycle trough is claimed to have happened in the middle of February, and here, this trough that we're just bouncing out of now is, according to this analysis, just the 20-day cycle trough. So we need to bear this in mind. This is a part of our analysis risk. Was that only a trough of the 20-day cycle? And how do you know? Again, I watched the FLDs. I'm sure you're getting an idea for this, a feeling for this now. I probably don't need to repeat all of this. Which FLD would I watch? If I'm considering a bounce out of the 20-day cycle, I watch the FLD 2 cycles shorter, so I will be watching the 5-day cycle, FLD. And so let's look at our 15-minute chart. Here is the 5-day cycle, FLD, and I think you can see, if we zoom back on this chart, that in fact, this is worth taking a little bit of a more careful look at. Let's put the 5-day FLD over here. What would we expect? Let me turn off the 10-day FLD. There we go. Okay, we would expect, if that was a trough of the 20-day cycle over here, we would expect price to cross up above the 5-day FLD, and then to come back and find support at the level of at the time of the 5-day cycle. Did it find support? Well, not very accurate support. I'm sure you will agree. It dropped down below that 5-day FLD, but it very quickly caught up again. So it shows you how these FLDs are not perfect all the time. Sometimes they are absolutely perfect. It's astounding, but sometimes they're not perfect. So there might have been a few sort of worrying hours there where it looked as if the 5-day FLD wasn't holding up. But that time quickly passed as price pulled up above the 5-day FLD. So we've been speaking about analysis risk, and the analysis risk that you take if your analysis is wrong is that the trough that you're trading, or the trough that price is bouncing out of, isn't the trough you expected. That is, of course, a risk that you take. But now there's another interesting analysis risk, I believe, which is that your analysis could have been correct, but you still bear analysis risk. Before we get to speak about that, I'd like to quickly show you how you can take this concept of FLDs even further. You can go all the way down intraday. Let's take a look at, this is a chart on MetaTrader 4, and here I have an FLD of the 2-day cycle. Look at how price interacted with this 2-day cycle FLD. I hope you can see this purple line. That's the 2-day cycle FLD. It's probably really dark on your screens, but that purple line is the 2-day FLD, and price broke out above the 2-day FLD, came back, found support at the 2-day FLD. Can you see that? And it came up again and has found support again at the level of the 2-day FLD. This whole process of monitoring the way in which price interacts with the FLD is a really, really useful and important process. Here's the 30-minute chart. You can see again price interacting with that FLD, finding support at the level of the FLD. This is a half-an-hour chart. And we can go shorter and shorter, and you're going to find the same things happening again and again. Here's the 1-day FLD. Look at that over there. Look at how price on Friday found support at the level of the 1-day FLD and continued bouncing up. This concept of watching how price interacts with the FLD is really useful, particularly after you've made a trade. That's the 5-minute chart. Not much new information there. Here's the 1-minute chart, and we don't have. We're coming down to an interesting FLD over there, but nothing particular there. Anyway, the point I wanted to make is that that process of going into shorter and shorter cycles and monitoring the interaction between price and the FLD is a really, really useful approach to take. Now, what if your analysis is correct? Do we still have analysis risk? Yes, I believe we do. And perhaps I'm wrong to call it analysis risk, but there is still some risk that we are taking, which is based around your analysis. And let me explain what that is. I'm going to zoom this chart out, because the analysis risk that you take, if your analysis is correct, has to do with your identification of the dominant cycle and what the expectation is in the market, even if your analysis is correct. We've been speaking for a few weeks now about price bouncing out of this 20-week cycle trough, and I've been speaking about it as if though it's the ultimate long trade that you can make. But is it? When price bounces out of that 20-week cycle, how high is it going to do? How high is it going to go? It's a lovely idea that we're going to trade as price bounces out of a 20-week cycle and then sit back for 10 weeks while the profits roll in. But the analysis risk that we take, even if we are correct, has to do with what cycles do in financial markets. In our discussions in the webinars a few weeks ago, I spoke about how the dominant cycle in the market was possibly or probably the 40-week cycle, maybe even a longer cycle, the 18-month cycle. And some people put a lot of effort into determining exactly which cycle is dominant. I used to do that. When I started working with Hurst cycles, I worked a lot with John Ehrler's work. I don't know if I pronounce his name correctly. John F. Ehrler's. He's he's been published many times, has written many books about applying rocket science to trading, for instance, something that appealed to me. And he does a lot of spectral analysis work and has indicators that perform spectral analysis. I did a lot of work with that in terms of determining what the currently dominant cycle was personally, but this is my personal approach. I found that if I had something telling me exactly what the dominant cycle was, then I tended to close my mind to other possibilities. And that became a little bit worrying. If I was absolutely convinced it was a 40-week cycle, then I wouldn't think about it being an 18-month cycle. And I prefer to think about all the options, which is why I do that now. I think about all the possible options. So let's first of all ask ourselves, what if the current dominant cycle is the 18-month cycle? Because it is possible. And I know some of you might say, no, it's not. It's the 40-week cycle. But in my opinion, it is possible that the 18-month cycle is dominant. So what are we going to see? We're going to see a typical M shape, but it's a particular M shape, and it's a rise up followed by a mid-channel pause. I've spoken about mid-channel pauses before, and so I won't dwell on them here, but the mid-channel pause for the 18-month cycle will form at the level of the 20-week cycle. Following the mid-channel pause, we get a bounce up to another high, move down to the 40-week cycle trough, which is expected roughly here, September perhaps, maybe earlier, maybe later, rise up to another peak, followed by a move down, mid-channel pause on the way down, and then drop down into the 18-month cycle trough. We've got a bit of a staggered nest of lows here, but it's somewhere there early next year, 2017. So that's what we're expecting if the 18-month cycle is dominant. So if the 18-month cycle is dominant, we've just traded. If this was a map of our future, there would be a sign saying you are here. Okay, you are here at the moment. So we've traded the move out of the 20-week cycle trough. That's fantastic. And if the 18-month cycle is dominant, then we're going to be trading this move up to this peak here. What is that peak? That is the peak of the 40-week cycle. Okay, so we're trading the move up to the peak of the 40-week cycle. Very important point. Now let me consider another possibility, which is that the dominant cycle is the 40-week cycle. That means that we would expect to see a move up to the first peak, a move down to the 20-week cycle trough, a move up to another peak, possibly a higher peak. At the moment it looks as though it is going to be higher, so let's assume it is. Then a move down to the 40-week cycle trough. Okay, can you see the clear move up and the clear move down within a span of 40 weeks? That's a dominant 40-week cycle. If we have a dominant 40-week cycle, then what is the expectation for our trade? Well, the expectation is not so good. Can you see that? Yes, our trade is still going up, but it's going up to this peak over here. So what is that peak? That is again a peak of the 40-week cycle. But it's not as impressive a peak. So it's not really such an exciting proposition. So what do we do, and what is our analysis risk? Why do I call it analysis risk? I call it analysis risk because your analysis has to do with all of the cycles that are active in the market, and includes an identification of what is the dominant cycle. So we need to watch this trade carefully as it unfolds, and we need to work out when is the peak of this 40-week cycle expected to happen. When is that peak going to form? Because that is the answer in terms of when we need to get out of this trade and make our profits. Now, let's see how we could possibly answer that question. First of all, we are definitely going to want to exit our trade at the peak of the 40-week cycle, as I've mentioned. When is that peak going to be? What's going to happen between now and the next trough of the 40-week cycle? Well, here's when we expect the next trough of the 40-week cycle in early October. Okay, and so we expect two 80-day cycle troughs two 80-day cycles to play out as price takes us into that 40-week cycle trough. So now, which one of those is going to be the peak of the 20-week cycle? So we have a 20-week cycle taking us from this trough to the next trough of the 40-week cycle, and one of these 80-day cycles is going to be higher than the other one. Which is it going to be? Well, you might decide that you want to stay in for the highest peak. Personally, I mentioned right at the beginning of this little series on making trading decisions on the basis of Hurst cycles analysis, I mentioned that I have a time frame that I like to trade. I'm trading the 40-day cycle here. I want to get into trades for a few weeks and then get out. So for me, I will want to exit at this first 80-day cycle peak. I don't really want to hold on for the second 80-day cycle peak. So I'm going to be focusing on this one over here. But if you want to work out where the highest peak is expected to be, you can, of course, use the rule of thumb of underlying trend. We are looking at the two peaks of a 20-week cycle over here. This is 20 weeks. So we can ask ourselves, what is the underlying trend of this 20-week cycle? Well, we look at the next longer cycle, which is the 40-week cycle. What is the 40-week cycle doing over this period of time between now and about October this year? The 40-week cycle is going to be heading downwards into the 40-week cycle trough. So that's a -1. The next longer cycle is the 18-month cycle. What is that 18-month cycle going to be doing? It's going to be heading up. That's a +1. And now this is where your opinion might differ. I believe that there is also a 54-month cycle trough here in February, so I would add an extra one. You might not. And some people might even add a +1 for the 7-year or 9-year cycle trough in February as well. I am going to go with this scenario, 54 months, 18 months, and 40 weeks. And therefore, I end up with a slightly positive underlying trend. Slightly positive is only +1, which would mean that I would expect the second peak to be higher. However, as I've mentioned, my trading time frame doesn't make it worthwhile for me to sit in here for 3 months while price struggles up to the next and second peak. So therefore, I'm going to be focusing on this peak here, the first peak of the peak of the first 80-day cycle. That's going to be my focus. That's where I'm expecting to go. However, I have a comment, and I think John might have mentioned something which has to do with what I'm about to say. John says, one thing I've noticed is that when coming out of very large cycle troughs, 42 months or 7 years, the 14-month or 18-month is very strong and prices rise for almost the entire cycle period before a sharp correction. Okay, that's a very interesting observation. So following a really big cycle trough, we might be in for a good 18 months of upwards move. Okay, so how would you deal with that? How would I deal with it? I don't know how you would deal with it, but let me explain how I would deal with it. What I'm going to be doing is focusing on my time frame, which is to stay in this trade for a few weeks. So I'm looking for price to come up to the first 80-day peak over here. At that point, I might take some profits and close out some of my trades. Or I might stay in, because if the markets are really looking very bullish, then what John suggests happens, or what he says happens often, might be taking place, which is that we are in the grips of a really strong, dominant 18-month cycle, and price is going to keep going up. So I will watch the correction as it comes down again. If it's strong and determined, then I will exit from my trades. But I might stay in and see if I can ride this move up even further. John's second point is that the other risk is a straddle trough into the fall. Okay, so let me show you. I'm not sure this is in response to John's statement, but there's another important thing to bear in mind here, which is that if we have a 40-week dominant cycle, which is possible, then what we've seen here with the 20-week cycle trough forming, even if our analysis is correct, what we've seen here is effectively a straddled trough. What happens after a straddled trough? Well, the market makes an M shape, and you get a fairly symmetrical, probably slightly bullish shape forming in the markets, and then prices are going to come down. So I am going to be watching carefully at the time that this peak forms, because it might be a very good time to get out of this trade. Now, the final thing I'd like to show you is a new feature in Sentient Trader, which is still in beta testing, so it's not available yet, but it will be available at the end of June, actually, to all our Sentient Trader users. And that is the ability to perform a dual analysis. And I've mentioned it before in these webinars. I've shown it to you. It's a slightly controversial feature of Sentient Trader, and some people are convinced it's a fantastic thing, and others are less convinced. But what I tend to do is I take a look at the peak analysis and find a peak analysis that makes sense, and use that peak analysis to help me decide when to expect these peaks. And that's really what we're doing now. We're in a long trade, so we want to know when should we expect the peaks to form. So let's have a look. Here is a peak analysis that makes sense. The peak analysis in that other chart wasn't very good in my opinion. I won't waste time now explaining why. But here's a peak analysis that looks fairly good. As you can see, if we focus on the peaks, according to this analysis, there was a peak of the 40-week cycle over here on the 19th of April, I think that was. A peak of the 40-week cycle, and price is now coming up into the next 40-day cycle, a peak of the 40-day cycle. And so we're going to get a move up into this peak, followed by a bit of a move down, which of course we expect. And here is the peak that I've been speaking about using as my exit, probably the peak of the 80-day cycle over here, perhaps the end of June, perhaps early July. So I find the peak analysis very useful, not necessarily for basing all of my trading decisions on, but I do find it very useful for helping me to identify when the peaks are expected to form in the market. And what this peak analysis tells me is that we are expecting a peak to form round about now. Of course, I'm going to be monitoring this to make sure that this is a trough of the 20-week cycle, as I've explained. And assuming that is a trough of the 20-week cycle, I will expect a bit more of a move up. And then over here, this very nice nest of lows, nest of highs over here is where I would consider the peak forming, which, as I've mentioned, is kind of early July, perhaps in the first week of July, perhaps in the last week of June. That's when I'm expecting a big peak to form in the markets, and that would probably be a really good time to take profits from this trade and go away on a big long summer holiday. But I find that a very useful feature for helping me to determine where those peaks are expected to form in the markets. And so that, in my opinion, is what analysis risk is all about. There are two forms of analysis risk. There's the risk that you take that your analysis is wrong. And the only way to handle that risk is to stay focused on the markets. Remember what your trading decision was based upon and monitor those cycles as they happen. And particularly watch the FLDs. I find that very useful, but that's because I'm obsessed by FLDs. You can use any of the Hurst cycle tools or any other tools to monitor the cycles as they develop. The other analysis risk is the risk you take if your analysis is correct. Just because price is bouncing out of a 20-week cycle trough does not necessarily mean that we're looking at 10 weeks worth of profits. We might be looking at more. We might be looking at less. But the important thing is to then keep in mind the bigger picture and work out what is expected in terms of the bigger picture and when is going to be the best time to exit from your trade. You should never sit there thinking, oh gosh, I wonder when I'll get out of this trade. Am I going to wait until Christmas or should I get out next week? You must have a plan. I see Paul says, can you use the FLD strategy with peak analysis? Yes, Paul, you can. It's wonderfully complicated. I wonder if I can show you a chart. Let me just see if I can load one here while I'm chatting. Yes, you can. Basically, the same sequence plays out, but it plays out upside down. And I mean, I'm used to talking about the FLD trading strategy. I've been trading the FLD trading strategy for as long as I can remember. But the upside down version can be sort of mind-bogglingly confusing because everything's upside down. I'm used to speaking about A category interactions, which happen, for long trades, and F category interactions are short trades and so on. And so here we go. Let me show you this chart. Let me see if I can drag it across here. Yes, here we go. And I think that's now in the frame. I think you should be able to see that now. Let me just get back to my, this is complicated. Where's my webinar gone? There we go. Okay. There we go, Paul. So in answer to your question, this is an analysis of the United States dollar Japanese yen from Hurst signals. And the Japanese yen, in my opinion, works with inverted cycles. So you can see the analysis up at the top of the chart over here. And here you can see the identification of those trading opportunities. Here's your A category interaction, which is a downwards interaction. Here is the B and the C and the D. It's all a bit sort of blurred and not very clear. But the simple answer is yes, you can. I've got one more chart here I can show you, because gold, of course, I think gold is also, if I can find this tab, yes, here we go. Let me show you this gold. There we go. So there you can see gold. That's also working on the basis of an inverted analysis. It works. It can be a little confusing, but it does work. Hube, if you look at the triad, you see additional information about the direction, which appears quite useful at the moment. Yes, indeed, Hube. Thank you for reminding me. The triad, for those of you who don't know, the triad is... let me just pull this down. The triad is 3 lines based on Hurst's half-span moving average. And sometimes the triad provides very useful information, sometimes it doesn't. Let's see. I'm not seeing much happening here with this, but if I zoom in, there we go. Okay, so where these lines interact, where these lines intersect, you generate targets. Okay, so anyway, the triad is another whole topic of conversation. But thank you for bringing it up, Hube. Kurt, keep that peak analysis in mind because there has been no new accumulation on this test of the highs. Okay, so that's very useful, and it's really useful to keep all these different things in mind. Trading is the most fascinating process I've ever been involved with, and it's really useful to watch things, all kinds of things. Volume. See how the volume has been playing out. I wonder if I have volume on this chart. I don't think I do. I don't think there is any volume, no. But watching volume and accumulation and so on is also very useful. Heath, what does the difference in average peak cycle length and average trough cycle length tell you? That's a really interesting question, Heath. There isn't really time to answer it, and I'm not sure I can answer it. I don't. The truth is, I don't really know what it does tell you. I must tell you the whole concept of the dual analysis, performing a trough and a peak analysis, is almost a flawed concept at the outset, because one of Hurst's fundamental principles is that troughs are synchronized and peaks are not. And yet what I'm doing here is performing an analysis assuming synchronized peaks and synchronized troughs. So it kind of goes against, basic principles of Hurst. But it is very, very useful. What you will find is that one of the analyses is usually much better than the other one. And interestingly, I always thought that the trough analysis would always be better than the peak analysis in stock markets, because stock markets have synchronized troughs, whereas not synchronized peaks. However, what I found quite interesting is that sometimes the sort of dominance of troughs and peaks tends to switch. And I could go on at length about the reasons why I think that is, but I won't bore you with that today. But I do believe that sometimes peaks become easier to analyze and troughs become harder. So, for instance, in the S&P 500 recently, this period over here, it's been very difficult to identify troughs because you've had that clean move up. So the trough analysis is struggling, and you get these staggered nests of lows. However, the peak analysis, you might notice, is looking very neat. Can you see those very nice, neat nests of highs? And that's an indication in my mind that the peak analysis, for whatever reason, is working better at the moment. And so what does happen is that you get different wavelengths between the peaks and the troughs. Why that is and so on is a huge subject, and I can't actually give you a specific answer. But it is because the two analyses are separate, completely independent analyses. They aren't linked. And the result of them not being linked, I think, reveals very, very useful information. If all you're doing is identifying the peaks of the trough analysis that you have already, then you're not adding much information. But with the dual analysis, you're adding quite a lot of information. John is saying gold and the US dollar, Japanese yen work together. Yes, which is why I think they both should be analyzed primarily with peaks, although I quite enjoy doing a dual analysis on them as well. And Hube says, look at the 20-week triad. Let's try that. 20-week triad. I've zoomed out a bit. It should 20-week. Ah, there we go. There's the 20-week triad. So what happens is with a triad is you get a bunch of these intersections, which are these diamonds over here. Not diamonds, these triangles. Those are the intersections which generally happen halfway up in the move, and here they are again, which should happen halfway down in the move, which probably raises the possibility, the likelihood, I should say, that that is a 20-week cycle trough. I hope that's what Hube's referring to. Brian, the original Hurst course doesn't seem to be available. I know, it's a tragedy. Does the Sentient Trader course cover pretty well everything in the original Hurst course? Brian, no, it doesn't. As a matter of interest, we are in the process of developing a new course that is going to cover analysis specifically, and is going to cover everything in that Hurst Cycles course, because there's been a really strong demand for it. I must tell you, it's been really wonderful to witness. There's been a big surge in interest in Hurst Cycles, and sadly, Traders Press, who published the Hurst Cycles Cyclitech course, they went bankrupt 2 or 3 years ago now. I had a lot of dealings with Traders Press, being obsessed with Hurst Cycles in the way I am, and I tried to get the rights to the Hurst Cycles course, but they were involved in litigation with people, and I don't know. Anyway, but there's a very big demand for that Hurst Cycles course. You can sometimes pick up a second-hand copy of the course on eBay. You can look out for that. Occasionally people contact us at Sentient Trader, and we put out messages on social media about the availability of second-hand courses for sale. But we are in the process of putting together a course purely about analysis. And in fact, one of the requirements is that you have to use pencils and chart paper to perform your analysis. I think it's a really important way of learning how to do it. So no, Brian, in answer to your question, the Sentient Trader course doesn't, unfortunately, because the Sentient Trader course was always built to teach people how to use the software to apply what they'd already learned in the Hurst Cycles course. Now, of course, the Hurst Cycles course isn't available, so there's a big gap. I would recommend you take a look at Christopher Grafton's book, Mastering Hurst Cycles Analysis, because that book is based upon the Hurst Cycles course, and it is still available. It is in print. So take a look at Christopher Grafton's Mastering Hurst Cycles Analysis. You should find a lot of very useful material in there. And we are going to be coming out with the course, I'd like to say soon, but it's taking us a very long time to produce it, as these courses do. But there will be a course available at some point. Okay. Mike, does the peak in the 51.8-week peak triangle marks mean the 2016 peak is in, or are they empty and still open? Okay, so Mike is referring to these hollow triangles here. Let me just tidy up this chart a little bit. He's referring to these hollow triangles. So here is a hollow triangle marking the peak of the 40-week cycle. The current wavelength of the 40-week cycle is 51.8 weeks, as you can see over there. And why is that peak hollow? That peak is hollow because it is the best of several fairly similar possibilities in the phasing analysis. So it is considered to be confirmed, yes. It's considered to be confirmed according to this analysis. That peak is there and it's in place. But the fact that it's hollow means that there hasn't been enough evidence following that peak to make it absolutely certain. Okay. And you can see why. If price comes up here and forms another peak just a few points higher and then plunges down, chances are that peak should actually be over there. So the way the diamonds work is that the diamonds and the triangles work is that they are positioned when the software is what I would describe as fairly confident that that is the peak. It only fills in those diamonds or triangles when it's absolutely convinced. Okay, if you can, I mean, I don't think software is convinced or whatever, but okay. And I missed a whole lot of things there. William says they usually switch in downtrends. That's very interesting. I think William's referring to switching between troughs and peaks, I think. And he's saying that they switch in downtrends. That's a really very interesting observation, as John says, from bullish to bearish. Okay, so I'm sure you're going to enjoy working with the dual analysis feature of Sentient Trader, where you can do peak and trough analysis and compare them to your heart's content. Hugh, it should have reached a minimum for the 20-week. Okay, I think I've answered that. And I've dealt with Mike's question. William, PFG bought Traders Press, then filed bankruptcy. Right, yes, there was a sad sort of business political thing that unfolded around Traders Press. PFG, William says that PFG bought Traders Press. Traders Press were wonderfully instrumental in bringing Hurst Cycles back to life. They published the Hurst Cycles course back in 2000. They were instrumental in really reviving an interest in Hurst Cycles, and so the people who bought Traders Press went bankrupt, and unfortunately the Hurst Cycles course it was tied up in the assets of Traders Press, and it wasn't possible to sort of get hold of them and start republishing at the time. Who knows, maybe things have changed. And with that, it's time for me to bring an end to today's webinar. Thank you very much for joining me. Thank you for your interest in Hurst Cycles. I look forward to seeing you next time in the Hurst Cycles trading room. If you have particular subjects you would like me to deal with, then please send us an email at info@sentienttrader.com. It's the best way of getting through to me when I'm online on these webinars. It usually goes over my head a little bit. I'm so busy talking. But do send me emails with any things you would particularly like to discuss. And I look forward to seeing you. Our next webinar will be in 2 weeks' time. Thank you so much for joining me, and thank you for your interest in Hurst Cycles.